Hello guys and welcome to this video. In this video we are going to analyze L7dex. I hope I'm pronouncing it correctly, and I will say L7 for the sake of the entire video and the white paper. So we are going to quickly jump to the white paper, but before that, in less than 10-15 seconds, let's go through the chart. This is the chart, and the price has been around 40.42, and now it has gone down to nearly $3. So pretty bad phase, I guess, for the token holders. But anyways, so now let's go to the white paper quickly, and this is the website. You can click here and go to the website if you want to. So now let's jump to the white paper, which is the most important part, and I am sure you are also here for that only. So let's get started. So this is the index, and now there is this forward. So let's see uh, what it says, and then we'll quickly go into the details of the white paper. So after witnessing a series of crashes from lending crypto service providers like Luna, Three Arrows Capital, FTX, and Genesis, investors unease regarding assets has reached an all-time high. It is very true, because ask FTX holders what happened to them, and you will know. Alertness to potential issues such as exchanges going bankrupt or running away, or you can say exit scam, market manipulation, and asset misappropriation has also risen, which is very true because the projects are generally centralized. So that's the reason why it happens. Centralized meaning that those projects only are handled by 5 or 10 people, so that's why it can happen. While centralized exchanges remain the mainstay for Web3 users, there is an increasingly evident trend of assets moving towards decentralized exchanges, which is very true. DEX, everybody in the world of crypto wants to use DEX platforms because they know that it is way safer, and nobody controls those funds generally, in most cases, I guess. The funds are stored on blockchain and not on the centralized server. That's the reason. The birth of DEX, decentralized exchanges, can be tracked back to Counterparty in 2014, which offered an innovative function, Counterparty DEX. All counterparty tokens could be traded on a DEX based on the Bitcoin network. Subsequently, Ethereum's OSIS DEX launched the first on-chain order matching and settlement, becoming an early source of liquidity for platforms like Uniswap, DYDX, and others. After OSIS DEX, the Uniswap, of course, was a revolutionary concept, and it literally changed the world of trading for sure, and it has changed the world of trading for generations to come. So of course I am a big fan of Uniswap. The concept of Uniswap, because I remember back, I'm talking about Corona times, I guess. In that period of Corona, I was literally, when I first understood the concept of Uniswap, I was really mesmerized by that and how it worked. And it was really, first at the first point, it was really a shock for me. And then I realized that how big this thing can be. So yeah, I understand that, at least. After OSIS DEX, we saw the gradual emergence of mature spot DEX like Uniswap, SushiSwap, and Curve derivatives contracts DEX like DYDX and Kujira, and order book decentralized exchanges like DeFi Exchange, known for low slippage, aggregated liquidity, and multi-chain trading. It is fair to say that this decentralized exchanges track is a crucial sector within the entire ecosystem. The entire ecosystem is about decentralization only. Even if you are going to launch your a cryptocurrency project in the future, then you will want the community to be decentralized. If your community is of 5 or 10 people, then I'm sure that you are not going to enjoy running such projects. So decentralization will always be at the core of the cryptocurrency market. The decentralized exchange of the future will lean more towards the development of user trading sovereignty and ways to enhance liquidity depth. L7 decentralized exchange provides traditional centralized exchange applicability to DEX, maximally coordinating the relation between liquidity, transaction efficiency, and investment returns. This position is a synchronously grow alongside the broader DeFi industry in the future. Sorry for the fumble. industry background. With the comprehensive development of the blockchain technology, Bitcoin as a store of value is no longer sufficient to meet people's pursuit of a decentralized world, which is very true. I mean, Bitcoin is the perfect product for store of value, but apart from that, there are no other use cases for the Bitcoin. And of course, what Bitcoin is doing is perfect as a store of value, for at least that's what I believe. And nothing in this video is investment advice. But what I mean to say here is that apart from that, there is no other utility of the Bitcoin network. So as a result, Ethereum based on chain, I think they missed the word chain, on chain smart contracts emerged, and with the improvement of various infrastructures, we entered the era of programmable blockchain. In this era, decentralized finance occupies a significant position. DeFi began to show its prominence in 2019, which also defined as the first year of DeFi, which with a total lockup volume of only 270 million. Not until 2020, when the compound launched these governance token, sorry, uh, compound comp, did the concept of liquidity mining, the most important in the DeFi world, enter the public eye, triggering a DeFi craze. Subsequently, so ultimately, the liquidity mining is also a form of decentralized promotion of decentralization, because it tries to lock people's funds and give them rewards based on the locking period, and providing liquidity to the network. And it creates a kind of, a connection between the community members and the token holders, so they can probably run the project in the longer run. So again, if you are going to launch your own cryptocurrency project, the same thing is going to apply to your project as well. You are also going to look for the ways to create a solid bond in the community for your project, because you know that no matter how great your idea is, ultimately you would want a great community. Without that, you are not going to survive. So liquidity providing, you'll have to understand the purpose of liquidity providing, and that is to create a solid connection and bond between the community members through the way of using their own funds. That's all. Subsequently, industry leaders began to transfer traditional financial gameplay to the blockchain to reduce the inevitable transaction friction losses and various issues brought about by centralization in traditional finance. According to a DA Prada report, the total lockup volume of DeFi skyrocketed from 32 billion in January 2021 to 833 billion in the first quarter of 2023. So which is, I believe that this is definitely a big truth, because um, uh, decentralized has a lot of value. It has the character of decentralization drives the value of this market. So that's why, again, as I said earlier, that if you are going to launch your own cryptocurrency project, then what is the single most important factor you will be trying to do? You will be trying to build a community, so your project can become more and more decentralized. And that's why there needs to be some form of community connection, community uh, bonding procedure through which you guys can build a successful cryptocurrency project. Now, the evolution of DeFi is an ongoing process. That's what I just mentioned earlier, that the bonding procedure is an ongoing process, and you will have to keep improving and doing that, so you can create a successful cryptocurrency project. And that's the power of decentralization. The more people join your network, the more people uh, try to use your project or use your product, the higher the odds that your project is going to be a successful project. And we can currently delineate it into three phases. DeFi 1.0 primarily focuses on upending traditional finance on the Ethereum public chain. During the DeFi 2.0 stage, the focus shifted towards establishing foundational infrastructure layers, with more and more ecological public chains becoming optimal choices. This transition turned liquidity into a foundational layer of DeFi, enabling more sustainable growth in the sector. DeFi 3.0 has begun to professionalize liquidity mining, lowering the barrier to entry for average investors and enhancing the yield from the farming. Again, yield farming and liquidity mining, they are both, one is for the rewards and another is for the another is for providing a liquidity to a particular cryptocurrency project. But again, in both the cases, the common goal is to build a successful community and create, not only to provide liquidity to the project, but also to build a strong and solid connection between the emotional connection between the community members. Many projects, even with this method, they fail to do that, and that's why many projects are failing in the cryptocurrency market. So again, if you want to succeed, then you cannot only rely upon the liquidity mining. Of course, it is a great concept, I really believe that, but if you truly want to succeed in the cryptocurrency market, then you will also have to try to build a community with a emotional connection, and that is going to be the key area, and it is going to be a defining factor for any cryptocurrency project. If the community doesn't feel connected with each other, then your project is going to fail, and you are also going to fail if you launch a successful cryptocurrency project. Because if you totally depend on the liquidity mining and yield farming, then the problem lies in that almost every project is offering this service. So in that scenario, there will be nothing new with your project, and in that scenario your project might fail. Now let's move forward. The public chain ethernet is the main battleground. The years 2019-2020 marked the early stages of decentralized finance, commonly referred to as the 1.0 phase. The Ethereum blockchain was the primary platform, leveraging its stability and traffic advantage for development. The focus of this stage was mainly on the transition from traditional financial models, including decentralized exchanges like Uniswap, SushiSwap, lending applications such as Aave and Compound, stablecoin applications like MakerDAO, and liquidity mining pool applications like Yen Finance. There were also derivative synthetic assets based on these foundations, such as Synthetics and UMA, as well as insurance projects like Cover and Nexus Mutual. These projects, which directly connected the traditional finance, were referred to as the DeFi 1.0 within the industry. This phase showed the powerful disruptive capabilities of DeFi, with decentralized exchanges such as Uniswap and SushiSwap, and one another one is PancakeSwap, which is also a great project, symbolizing the emerging charm of the new financial ecosystem. However, as exploration continued, the development of DeFi started facing limitations and needed fresh momentum. With any DeFi project, decentralized, wherever there is decentralization involved, there will always be constant momentum required. So even if you are going to launch your own cryptocurrency project, then in that scenario also, you will have to keep working hard towards making your project more and more decentralized. Because if you do not do that, then it is very likely that your project is going to fail. So ultimate reality is that the change is the only constant, which is very that's what they're trying to say here. First, it was constrained by the performance of the underlying blockchain. Second, the user relationships in the DeFi 1.2 ecosystem were too dispersed. There was no connection between participants, leading to a lack of motivation to partake in platform governance. This seriously hindered ecosystem development, making it difficult to sustain platform liquidity, which is very true. So the problem still is going to be the same. Even in the longer term, this same problem will occur, that the participants or the token holders will not be interested in the project. And that's why I keep saying that if you want to succeed in the cryptocurrency market, then it is your job to create a solid community or strong bond between the community members, so they can keep taking care of the project even if when you are not around. And the big investors, if they're going to invest in your project, then what they're going to look at, it is they are going to look at only one thing, and that is how strong is your community. And I understand that building a community is going to be a very difficult task, because the thing is that people are not, people centric. People are not people centric, that's all I can say. And that's the reason why it is very difficult to build a successful community in the cryptocurrency market. If when probably you are going to make a content like me, and nobody is going to watch your content, that will be your first fear of failure. And then even if people watch your content, I mean, a lot of people watch my content, but they are not going to probably join your basic Telegram group. I also have a Telegram group. They're also not going to join your Telegram group, and they are not going to take part in your, even general group. Forget about the paid group or other NFTs or tokens, whatever you're trying to sell to build a community. They are not going to take part in those things as well. So that's the reason why I believe that focusing on party connection, creating a bonding between the participants is going to be the key area of focus forever in the cryptocurrency market. Now, third, the advantages of DeFi 1.0 over traditional finance attracted a large influx of capital into the sector. However, DeFi requires a multi-party game to solve the problem of project cold start. Project parties provide token rewards. Again, cold start means what? Cold start means that the community is not taking part in your project. That is always going to happen, and you will have to sustain those problems, because if you do not sustain, if you get tired while building a community, then you are not going to survive in the cryptocurrency market as a project owner or as a cryptocurrency founder. So that's why it will be your tireless job to build a successful community. A significant amount of capital is directed based on the APY of different projects, and over collateralization is required for borrowing and lending, resulting in an inefficient use of capital. So which is very true, that to build a community, people give high rewards and different kind of APIs on different projects and all that stuff. But in the end, the problem lies in the community. If the community doesn't feel connected with each other in your own cryptocurrency project, then your project, no matter how much efforts you give, your project is going to fail always. So yeah, and that's why you cannot give up. You'll have to keep doing what you have to do. Finally, in terms of liquidity mining, the constant release of liquidity supply compensation led to selling pressure, as well as the problem of user ruthlessly mine, withdraw, and sell, which is very true as well. Now, DeFi 2.0 is a DeFi application built on the first generation of protocols. It involves a fresh round of innovation, moving from 0 to 1 again. Hence, it can be considered as the second generation protocol called DeFi 2.0. Its core is transforming liquidity into the basic infrastructure layer of DeFi, which allows DeFi to be more sustainably developed and represents an evolutionary trend in the ecosystem. DeFi 2.0 has addressed many problems and limitations of DeFi 1.0, constantly exploring further in terms of scalability, security, decentralization, liquidity, and information accessibility. Its goal is to provide better financial services for the public. A key advancement of DeFi 2.0 is that it offers greater flexibility of staked assets. Again, staked assets is basically a form of locking the funds of the token holders and giving them the rewards against that. But again, the core idea of staking the asset is to build a stronger community and to create a community which is emotionally connected with each other. And again, you have to understand the core idea of staking the asset. So it is not necessary to if let's assume that you are launching your own cryptocurrency project, then it is not necessary that your token holders need to stake any kind of assets if they want to participate in your projects, because the core idea of staking the asset is what? It is to create a emotionally connected community, people who are emotionally connected with each other. So that's what you need to understand if you really want to understand the concept of staked assets. So just keep that in mind. Now let's see this chapter, uh, professionalized liquidity mining. DeFi 2.0 with its protocol controlled liquidity PCL. By the way, if you are thinking where we are on the white paper, then you can always check the page number here if you feel lost what I'm talking in the white paper. Now, DeFi 2.0 with its protocol controlled liquidity PCL primarily addresses the capital efficiency problem of DeFi 1.0, while DeFi 3.0 professionalizes liquidity mining business. In this version, protocols devise corresponding farming strategies to generate revenue and return the profits to token holders. This concept is often referred to as farming as a service, aiming to lower the entry threshold for ordinary investors and enhance farming returns. But generally, this doesn't actually turn out to be the way they have mentioned it here. Generally, most investors, they lose their money when they go to farming and other farming type of services which they use, because the problem with all those projects lies in the community. They cannot build a decentralized community, and that's why those projects fails. And that's the reason why, if you don't want your investors to lose money in your own cryptocurrency project, then what you need to do is build a solid community. Emotional connection between the community members will create a successful cryptocurrency project, and then those token holders who hold tokens of your project, they are likely to succeed. with your own cryptocurrency project. DeFi 3.0 protocols offer farming as a service, crafting professional and diverse cross-chain farming strategies compared to regular investors' individual operations. If DeFi investors don't have to spend time researching and selecting safe pools with high APY, nor do they need to transfer assets across different liquidity pools. This also now well, this is not entirely true, because most investors are going to do a lot of research when it comes to investing in their own money. And why are you watching this video and reading the entire white paper with me? Because you want to do the research regarding the project. So this is not entirely a correct statement, at least for me. Nor do they need to transfer assets across different liquidity pools. This also eliminates the risk of on-chain operations. By merely holding the protocol's token, investors can share the profits earned by the protocol through farming. DeFi 3.0 lowers the entry threshold into DeFi and boosts return, especially for ordinary users. DeFi 3.0 protocols implement a certain proportions of transaction fees buy sell. A portion of these fees flow into the protocol's treasury, where the funds are farmed according to protocol's strategy. The profits are then used to buy back tokens, reducing supply to maintain token price, and a part of the repurchased tokens is rewarded to token holders in the form of airdrops. So again, the buy and sell tax which they're talking is also a form of building a community. So let's assume that you invest $100,000 in a particular cryptocurrency project, and you upfront pay 5% buy fees or buy tax, which they say sometimes. Then you basically what they try to do is they try to make you feel connected with their own community through the tax system. So sometimes it is said that your heart is where your money is. So following that particular line, sometimes this buy and sell tax system works very well, but in most cases it fails because communities still, even after paying such taxes, they don't feel connected with each other. And that's why I keep saying that the more you focus on building your successful community, and emotional connection between your community members, higher the odd that you are going to survive and succeed with your own cryptocurrency project. And again, this process is going to be very lengthy, and it is going to be very tough for everyone. Even it is very tough for me as well. And a lot of people simply watch my videos, but they never take care of joining my Telegram community. So this is a pretty standard procedure, and you cannot just get tired by all this. And this is going to be your alone's work. It is going to be you working in your own room for probably years to make a project successful. So that's the reason why bonding between the emotional connection cannot be bought by throwing buy and sell tax on the people. But this has been working, and this is a pretty standard practice in the cryptocurrency market. So what they're saying is very genuine and very correct, that this is not something which is new in the cryptocurrency market. It's been around for a while. Additionally, token holders can also earn a certain percentage of transactions fees from each transaction as a reward. Transformation, advancement, and prospects of decentralized exchanges. The foundation of DeFi lies in public chain layer with aggregators on top and a core layer in between, namely DEX, lending derivatives, and stablecoins. This constitutes the core of DeFi. DEX is one of the most important infrastructure in DeFi and the subtract with the highest income, accounting for half of the DeFi tracks income. The earliest DX can be tracked to the counterparty protocol established in the 2014. I know counterparty. I remember that protocol. I don't know where it is right now, but at least if I talk about the 2017 bull market, I mean 2017 and bull market, when Bitcoin reached $20,000 for the first time. I remember this project, and the price of this project counterparty also went pretty significantly up. So I don't know where this project is, whether it is around or not, because it has been 7 years and I haven't heard anything from this project. However, due to the market conditions and the small ecosystem at that time, counterparty decentralized exchange did not receive significant market attention and gradually faded from public view. See, I told you that this project, I don't know, after 2017, I do not remember it. By 2017, amidst the rampant ICOs, IDX, and a decentralized exchange at that time, served as a primary venue for Ethereum token holders to convert digital assets, especially after the ICO bubble burst. In November 2018, UNICEF was launched, which actually I came to know about UNICEF in the late 2019. So after 1 year, after 1.5 years. So I was pretty late in knowing, but UNICEF did made its mark in the history. I'm pretty sure because it was revolutionary. Although Bancor was pioneer in using the AM model, again Bancor protocol was very, at the peak in the 2017, at the 2017 era. I remember few coins like Ethereum, of course, did great, and then there was this project Nano. Right now it is Nano. At that time it was called Riblocks, and Nano was also one of the projects which made its mark in that 2017 boom, and Bancor protocol was also one of them. In 2018, decentralized exchange trading volume saw explosive growth, reaching 2.7 billion. In 2019, DX trading volume slightly contracted but still surpassed 2.5 billion. Of course, 2018 and 2019 were literally, the worst years, and especially 2019, because in 2019 Bitcoin touched 3,000 twice, from uh, the 20,000 mark. So that's why it was the worst years, and during that period I'm sure that the volume would also go down. In the first half of 2020, Aave, Curve, Balancer, and Uniswap V2 were successively launched. In the June the same year, Compound started liquidity mining. The combination of lending and DEX led DeFi users to start receiving rewards for lending on Compound. Additional incentives in the form of Compound tokens caused the supply of different tokens and borrow APY surge, thus initiating the DeFi summer saga. Then came the clever move of Sushi Swap, igniting the liquidity race. In the first half of 2020, the entire digital asset market experienced a severe liquidity drought incident with a significant market downturn. After experiencing an explosion in market capacity, market stress tests, and a second reshuffling of the situation, DX under the AMM model represented by UNICEF, Sushi Swap, and Curve Finance accelerated their operations while continuously improving. Both market trading volume and the number of users saw exponential growth. By the December of that year, the trading volume of the top 9 DX increased by almost 18,000%, reaching a level of $29 billion. Pretty billion with a B, which is a pretty high number. However, a new challenge emerged in the decentralized scene in 2020: the ever increasing Ethereum gas fees and congestion. This led to the explosion of new public chain and layer 2 ecosystems in 2021. The market size of DEX grew rapidly and the market competition became increasingly fierce. Many decentralized exchange faced competition from DEX on non-Ethereum public chains such as MDX on Heco chain, PancakeSwap on BSC, Serum on Solana, and Kyber DMN on Phantom chain. So again, decentralized exchange market, or anything in crypto which is related to decentralized, is always going to face competition. So let's assume that you build a community that is trying to create a successful cryptocurrency wallet, and who will be your competition? Your competition is going to be only another community approach that is trying to create a wallet. If you think that you alone can create a successful cryptocurrency wallet, then good luck, but it is going to be very tough for almost anyone on the planet. But if you're trying to build a community, then you are always going to face the competition with other people like you who are also building a successful community that creates a successful cryptocurrency project of successful cryptocurrency wallet. Of course, wallet is an example. You can create any cryptocurrency project you want and build a community, but whatever you do, you are going to face a competition. So competition is always going to be at the forefront of any cryptocurrency market. Today, the development of decentralized exchange is no longer limited to providing a single function such as spot trading or contract trading. With the AMM model becoming increasingly mature, it has broken the limitations of order books and matchmaking, helping DX to overturn CX monopoly on the cryptocurrency trading market and making permissionless, open, and free on chain trading a reality. DX began to give uh, a portion of the trading fees to liquidity providers. Of course, Uniswap does that too. And when I again, when I understood first time that if you provide liquidity on Uniswap, that you get rewards a certain percent of trading fees, then immediately I understood that this concept is literally revolutionary, because now anyone can provide liquidity and start making money, thus democratizing the ways to enter the market. Again, just exactly what I said, that's what they are saying here, that thus democratizing the ways to enter the market for market making and providing liquidity. That's what I just said, right? So uh, yeah. It allowed investors to seamlessly trade between cryptocurrency in a completely decentralized and non-custodial manner through pre-collected on-chain liquidity pools, which is very true. Decentralization and non-custodial, they both go hand in hand. So if you have your own cryptocurrency project, then in that scenario also, if your community is going to run your project, let's say you have a community of 100 or 200 dedicated token holders who are going, who take charge of the day to day operations of your project, then your automatically your project becomes non custodial, meaning that nobody has the custody of entire project. So let's assume that out of 200 people, let's say 5 people uh, get out of the project, then still your project is going to run, because your project is technically non custodial, because it is a decentralized project. By simply depositing funds into the this on-chain liquidity pools, liquidity providers can earn passive income based on their percentage contribution to the liquidity pool. In the future, based on the ideal of DeFi inclusive finance, the development and evolution of DEX will likely undergo the following changes. Decentralized exchange will no longer be judged by the TVL metric, but rather EVL, effective value locked metric, which refers to the value that is actually being utilized. It does not replace the concept of TVL, but adds an additional dimension to the measurement. When evaluating a DEX, in addition to being concerned about the value that is locked, it is more important to focus on the value that is being utilized. The number of DEX will increase and liquidity will become more and more dispersed. Users will prefer to trade through DEX aggregators only, which is, I guess, pretty true. Right now, even if people are using centralized exchanges, then the only reason for people to use centralized exchanges is that DEX cannot still create such features like quick trading, or let's say that you are trading on Binance futures, then that level of experience cannot be created by the DEX. That's why centralized exchanges are surviving, but in the future it might not happen. With the improvement of public chain performance, the flexibility of order book trading may prompt some DX models to switch back from AMM to order book made in the future. DX will coexist in both modes. The new era of contract DEX, the construction of the decentralized financial system, is from the bottom up. Stablecoins, lending, and DEX as the underlying financial infrastructure satisfy users' basic needs for asset preservation, capital flow, and asset trading. As the DeFi Lego gradually piles up, the next step naturally targets high level user needs derivative trading. Derivative trading originated from the spot trading. Compared to spot trading, derivative trading has a richer application scenario, can also help users flexibly respond to different market trends, amplify profits, hedge risk, hedge futures, optimize resource allocation, etc., and meet users more diverse and complex financial needs. To the bear market cycle, the growth rate for of DeFi users introduced more active funds to the market, laying the foundation for DeFi's next explosion. Looking at the potential growth space of the market, both the traditional financial world and the cryptocurrency market based on centralized exchange, the volume of derivative trading is much higher than the spot trading, which is very true, because the core nature of people is to gamble. Although centralized exchanges still dominate, perpetual contract DX also saw significant growth during the market rebound. According to data from the token terminal, only the trading volume of perpetual contract DX increased by 77% year on year. Now let's quickly move to the L7dex overview. So now, guys, the video has already been pretty long. So what I will do is I will try to create part 2 of this video, and I'll try to hopefully finish this entire white paper in the part 2 of this video. I thought that I'll be able to do that in this video, but by far it is not going to be possible because the white paper is pretty long. Generally white papers finish in 10 to 12 pages, but this white paper has almost 33 pages. So what we'll do is I'll just post stop the video at the page 12 here, and I'll make the part 2, so you can join me in the part 2, and also you can join me in my Telegram community if you have any questions regarding any cryptocurrency project. So yeah, I'll see you in the next video, part 2 of this video, and till then, take care. Bye bye, and don't forget to like the video, subscribe to the channel, and you can join my Telegram group if you want to. Take care. Bye bye.